Part 3 is where it becomes a decision, not theory, not history, a practical framework for how to hold gold and Bitcoin as the system moves through what we believe is the most significant monetary transition since the end of Bretton Woods in 1971. Welcome back to Bitcoin Capital Gold. Let's close this series out. Before we get to positioning, there are two things happening right now that most investors have not connected to their gold and Bitcoin portfolios yet, and both of them change the scale of what is coming. The first is the stablecoin debt wipe. It sounds complex. It isn't. Here it is in plain English. The U.S. government has $39 trillion in debt. It cannot raise taxes enough to pay it down. It cannot cut spending enough to close the gap. And as we showed in Part 2, it cannot afford to pay free market interest rates on that debt forever. So the question becomes, how do you make $39 trillion manageable without formally defaulting? The answer is inflation. You repay the debt in dollars that are worth less than the dollars you borrowed. Every year, inflation runs above the interest rate on that debt. The real burden shrinks. This is financial repression used by indebted governments throughout history. But here is the 2026 version of that playbook, and it is elegant in a way no previous generation of policymakers had access to. The Genius Act, signed into law in July 2025, created a regulatory framework for stablecoins. Every stablecoin issued must be backed one-to-one by US dollars, short-term treasury bills, or Federal Reserve credits. Treasury Secretary Debasement projected the stablecoin market could reach $3.7 trillion by 2030. Now, follow the chain. Global users, businesses, individuals, countries that lack stable banking systems adopt dollar stablecoins for everyday payments. Each stablecoin they hold requires a U.S. Treasury bond to back it. So as global stablecoin adoption grows, Treasury demand grows with it. The U.S. can keep issuing debt at lower yields because there is a structural new buyer, the stablecoin system, that did not exist 5 years ago. Meanwhile, the Fed cuts rates. Yield curve control suppresses long-term yields further. Inflation persists above those yields. The dollar's purchasing power quietly declines every year, and the $39 trillion in debt, measured in real terms, shrinks. Nobody voted on it. Nobody announced a default. The debt simply gets inflated away through a system that simultaneously appears to strengthen dollar dominance globally through stablecoins. Debasement called it dollar supremacy. What it actually is for gold and Bitcoin investors is the confirmation that deliberate, managed dollar debasement is now official U.S. policy, not accidental, structural. That is the single most important context for everything that follows in this video. The second piece connects to something we introduced in Part 1, the Petrodollar fraying, but we need to take it one step further because the consequences for bond yields are severe, and most investors have not followed the chain to its conclusion. For 50 years, Gulf states, Saudi Arabia, UAE, Kuwait, Qatar, recycled their oil profits into U.S. Treasury bonds. They earned dollars from oil sales, and those dollars flowed straight back into U.S. debt. This created a permanent structural buyer of treasuries that kept yields artificially low for decades. That recycling is ending. Saudi Arabia ended its petrodollar agreement with the U.S. in 2024. Gulf states are diversifying into gold, into Chinese assets, into sovereign wealth funds investing in infrastructure and technology across the global south. The profits from oil are no longer automatically returning to U.S. treasuries. And here's what that means for bonds. When a structural buyer of that scale quietly exits, someone else has to absorb that supply. Either yields rise to attract new buyers, which the U.S. government cannot afford, or the Fed steps in and buys the bonds itself, which is yield curve control. Or the stablecoin system creates new synthetic demand, which is the Genius Act playbook. Most likely, all three happen simultaneously, but the direction of travel is clear. The era of naturally low U.S. bond yields, supported by petrodollar recycling, is over. The bond market is now managed, not by free markets, by policy. This is the moment of recognition that serious long-term investors are reaching. The system that kept fiat money stable for 50 years is unwinding, and the assets that exist outside that system become not just attractive, but necessary. Fiat was always a promise. The question is whether the entity making the promise can keep it, and the answer right now is only by making the promise worth progressively less. Gold has been the answer to broken monetary promises for 5,000 years. Bitcoin is the answer this generation built, mathematically fixed, sovereign-proof, and increasingly institutional. Both exist outside the system being managed. That is why both matter. Now, the positioning. This is what the series has been building toward. We are not going to give you a fixed percentage split. What we are going to give you is something more useful. A framework driven by one single number that tells you where we are in the cycle and what to do when that number moves. That number is the 10-year TIPS yield. TIPS stands for Treasury Inflation Protected Securities. The yield on a 10-year TIPS bond is the real interest rate, already inflation adjusted. It serves as a critical macro indicator for allocating to Bitcoin and gold, and is available free every trading day on the Federal Reserve's FRED database. Search for 10-year TIPS yield, bookmark it. This is the chart that tells you what your gold and Bitcoin portfolio should be doing. Both gold and Bitcoin typically move inversely to real yields because they are non-yielding alt-fiat assets that become more attractive when government bonds offer low or negative real returns. When 10-year TIPS yields fall, it signifies that the inflation-adjusted return on safe treasury bonds is low, making gold and Bitcoin more attractive stores of value. Here is how to use the 10-year TIPS yield to acquire and manage Bitcoin and gold in a portfolio. The core strategy: inverse correlation timing. Buy or increase allocation, falling 10-year TIPS yields. When 10-year TIPS yields fall, it means the real return on safe treasury bonds is decreasing. Investors seek alternative stores of value. This is the optimal time to buy gold and Bitcoin, as both tend to rise in this environment. Sell or reduce allocation, rising 10-year TIPS yields. When 10-year TIPS yields rise, often due to Fed tightening, the opportunity cost of holding non-yielding assets increases. Capital flows out of Bitcoin and gold and back into treasuries. The danger zone: a rapid rise in 10-year yields, often towards 4.5 to 5%, typically puts intense downward pressure on Bitcoin and risk assets. Portfolio allocation framework. Gold, left tail hedge, defense. Use gold to protect against volatility. When 10-year TIPS yields are high but inflation is also high, gold serves as a stable hedge against policy concerns. Bitcoin, right tail hedge, growth. Use Bitcoin for high-risk, high-return potential. It is highly sensitive to liquidity. Thus, when real yields are falling and liquidity is rising, Bitcoin tends to outperform. Combined approach. Consider a structure such as 75% gold, 25% Bitcoin. This combines the stability of gold with the high returns of Bitcoin, often reducing overall risk-adjusted returns compared to 60-40 portfolios. Practical implementation steps. Monitor key rates. Track the daily 10-year TIPS yield, available on FRED or TradingView. Watch for real yield divergence. If nominal yields rise but inflation expectations rise faster, the real yield, TIPS, falls, which is positive for gold and Bitcoin. Rule-based rebalancing. Because Bitcoin is highly volatile, rebalance the portfolio regularly, for example monthly, to ensure the target allocation between Bitcoin and gold is maintained. TIPS yield above 1.5%. Bonds are genuinely competitive. Investors can earn a real return from government debt. Both gold and Bitcoin face headwinds in this zone. We saw this in 2022. TIPS yields surged above 1.5% and gold fell 18%, while Bitcoin collapsed 62%. This is the zone where patience is the strategy. Hold your positions. Do not aggressively add. If you are adding at all, lean gold over Bitcoin. It falls less and recovers faster when real rates are high. TIPS yield between 0 and 1.5%. This is the transition zone. Real returns from bonds are declining but still positive.
Historically, this is where gold and Bitcoin begin to build momentum. Central banks and macro funds start accumulating gold quietly in this zone. Bitcoin stirs but has not broken out yet. Dollar-cost averaging into both makes sense here, heavier weighting towards gold as it tends to move first and with more institutional certainty.
TIPS yield below zero. Negative real rates confirmed. Cash and bonds are actively destroying purchasing power. This is the environment where gold accelerates and Bitcoin follows. We saw it in 2020. TIPS yields crashed below zero and both assets surged. If YCC is implemented and the Fed is deliberately suppressing yields below inflation, this is the zone we will be in by design, potentially for years. In this zone, lean into Bitcoin more aggressively relative to gold. Bitcoin's upside in a sustained negative real rate environment is historically multiples of gold's move. Gold protects, Bitcoin grows. TIPS yield below -1%. Maximum allocation territory for both assets. This is the 1940s scenario we described in Part 2. Deeply repressive financial environment. Dollar losing purchasing power faster than most investors will realize until it is too late to position. Gold protects the foundation. Bitcoin provides the asymmetric upside. Both are essential. As of early April 2026, the 10-year U.S. TIPS, Treasury inflation-protected securities, yield is approximately 1.96% to 2.01%, representing the real, inflation-adjusted, return on government debt. These yields have generally risen from previous years, reflecting investor expectations for sustained inflation and adjustments in central bank policy. Current 10-year TIPS overview. Yield range. The 10-year TIPS yield has recently fluctuated around 1.96% to 1.99%. Market context. A higher TIPS yield indicates a higher cost of capital and stronger real returns, often occurring when investors believe inflation will be persistent. Break-even rate. The spread between the 10-year nominal Treasury bond and the 10-year TIPS, the break-even inflation rate, is often around 2.3 to 2.5%, representing market-implied inflation expectations. For real-time data and historical charts, you can monitor the Macro Trends long-term TIPS yield chart. Caveat: Bitcoin's reaction to yield surges can be inconsistent, sometimes behaving like a high-risk tech stock rather than digital gold. Beyond the TIPS yield levels, there are 4 specific signals that tell you when the environment is shifting and what to do when it does. When real rates are falling, the TIPS yield moving lower, this is the signal to gradually increase Bitcoin allocation relative to gold. Bitcoin has more upside in a falling real rate environment. The liquidity entering the system finds the highest beta scarce asset. This is not a signal to sell gold. It is a signal to let Bitcoin run and not trim it too early. When real rates are rising, the TIPS yield moving higher, shift toward gold and reduce Bitcoin exposure. Bitcoin sells off harder than gold when liquidity tightens. Gold is the defensive position. It falls less, it recovers faster. We saw this in 2022 and briefly in the Warsh nomination sell-off. When yield curve control is officially announced, when the Fed explicitly states a yield ceiling on long-term treasuries, this is the maximum gold signal. Central banks will be buying. Sovereign wealth funds will be buying. History says gold moves 15 to 30% on that announcement alone. Bitcoin benefits too, but gold moves first, faster, and with more institutional certainty in the immediate aftermath. When the dollar weakens sharply, the DXY breaking below key support levels, both assets benefit, but through different timelines. Gold responds almost immediately because it is priced in dollars globally. A weaker dollar makes gold cheaper for every other currency in the world, driving demand instantly. Bitcoin follows, typically with a lag of weeks to months, as the liquidity generated by dollar weakness eventually flows into the highest beta assets. So what does the return stacking framework actually look like in practice? Gold is the foundation. It is the part of your portfolio that holds its ground when everything else is uncertain. It does not give you explosive upside, but it does not collapse 60% in a bear market either.
In the environment we are describing, negative real rates, YCC, dollar debasement, gold does not need to be explosive. It needs to hold purchasing power while everything denominated in fiat quietly loses it. That is an extraordinary outcome without needing to do anything dramatic. Bitcoin is the asymmetric layer on top. It is the bet that this generation's version of hard money, fixed supply, sovereign-proof, increasingly institutional, performs in a debasement cycle the way gold has in every previous one, but faster and with greater magnitude. The risk is higher, the potential return is higher, and critically, it's a separate driver from gold. Both are hard assets, but they are not the same hard asset. Holding both means you're not choosing between the 5,000-year answer and the 15-year answer. You're holding the answer to the monetary question at two different speeds and two different risk levels. The TIPS yield tells you when to lean one way or the other. That's return stacking, not a trading strategy, a framework for two assets that serve related but distinct purposes as the most significant monetary transition of our lifetimes plays out. So let's close the series. In part 1, we showed you that the bond market is the engine of the global financial system. Real rates are the master variable. The current environment, oil shock, stuck Fed, weakening dollar, Petrodollar exit, has set the stage for a macro shift of historic proportions. In part 2, we showed you that yield curve control is deliberately being assembled. Negative real rates by design are the destination. Gold is the primary beneficiary. Bitcoin follows with leverage. Japan's rate hike creates near-term pressure, but the floor holds and the supercycle builds from there. In part 3, we connected the final pieces. The Genius Act stablecoin system is how the U.S. inflates away $39 trillion in debt while appearing to strengthen dollar dominance. The Petrodollar exit removes the structural bond buyer that kept yields low for 50 years, making yield curve control not just likely, but necessary. And the 10-year TIPS yield is the one number that tells you where we are in the cycle and how to position between gold and Bitcoin. The supercycle is not coming. It's here and already building. The yen carry trade unwind may still impact some downside on gold and Bitcoin, but the market by and large appears to have absorbed this future event. Gold at current levels is not the end of the move, it is the institutional accumulation phase that precedes broader recognition. Bitcoin's near-term volatility is the entry point the supercycle will eventually make look obvious in hindsight. The investors who look back at 2026 as the year that mattered are not the ones who predicted every move. They're the ones who understood the structure and held. Subscribe to Bitcoin Capital Gold. If this 3-part series gave you a framework that changes how you think about your portfolio, share it. Most investors are watching the stock market. The bond market already moved. Gold and Bitcoin are responding. See you in the next video.